Hi, I'm Bill Blain, strategist here at Shard Capital. As we approach October, there are equinoctial gales blowing outside my window. Many market participants think the markets are also due a storm. October is often the most dangerous month for market crashes, and at the moment that looks to be nailed on. Investors are increasingly concerned at just how vulnerable the US market looks to overvaluations, bubbles, and the looming presidential election results. As a result, buyers are looking at other markets to determine if they offer more value. Predictably, investment banks, who let's not forget are anxious to sell more product, are suggesting that Europe looks undervalued compared to the US. And hey, that's a great reason to buy Europe. Whoa, just because Europe is cheaper doesn't mean that it's better value. Now, there are many great European companies, and I would certainly recommend buying them when the prices look right. But aside from fundamentals like the advantage of one company over another, there are very few reasons to pile into Europe at the moment. All global stock markets are in a correction phase. Till we get the pandemic out the way, it's likely to stay that way. Now, the reasons for thinking that European stocks are good value include very similar arguments as those which explain why the US markets are so strong. The US is strong because of QE. It's the same in Europe. The ECB is pumping money into Europe through quantitative easing infinity, sovereign debt purchases, and corporate debt purchases. They're keeping interest rates low and giving the banks free money in order to avoid crisis. But despite the ECB's efforts, it's having zero effect on fighting endemic European deflation and rising unemployment. Now, Europe should be doing better. The weakness of the Europe should be helping exporters, and it will help Germany. Low oil prices should help, but that's proving deflationary. Unemployment, especially youth unemployment, is proving very stubborn and difficult to cure in southern Europe. But the major difference between the US and Europe and US stocks and European stocks is all about confidence. All the markets have been hit by the pandemic, but there are certainly signs the US economy is proving more resilient than Europe. The US is fueled by hopes for recovery and also by a very small number of tech stocks which have staged massive market gains. In Europe, the mood is fundamentally different and more conservative. Gains are fueled on rumours of possible M&A, mergers and acquisitions, where firms try to buy assets on the cheap. Markets are beginning to lose faith in Europe, and that is most clearly demonstrated when earlier this week the Norwegians announced that they are going to pivot their 1.15 trillion pension fund away from European stocks towards US equities, cutting Europe from 33% to 26% and raising US allocations to nearly 50%. Why? Because the US better represents the distribution of value creation, said the Norwegian Minister of Finance. Now, US stocks now represent 65% of global market capitalization. Europe was 50% of Norway's equity fund as recently as 2012. Whatever, the Norwegian decision to switch into America and Asia is an ouch moment for Europe. The announcement was wrapped up in diplomatic flannel so that no one was offended, but the Norwegians don't have much faith in European recovery. They believe that Europe is undervalued for a reason compared to the US. They know bankers speak and when to ignore it. Now, during the last unpleasantness with Germany, the Norwegian government fled to Scotland. They based themselves in Edinburgh in what is now Heriot-Watt University. As a result, my student days involved carousing with a lot of very wild Norwegian students. They are brilliantly bad and funny people. I got to know many of them well, and many of them have ended up in finance. Their views on markets and opportunities in Europe versus the rest of the world are absolutely fascinating. The Norwegians don't want their economy being too closely aligned with the reality of the Japanification of Europe or Brussels' faceless bureaucracy. They don't want to buy into ongoing recession and low growth prospects. They need their economy, and more importantly for them, their state pension fund, to grow by shifting their investments towards a sustainable global growth perspective. Politically, they will remain neutral, but they want to shift away from Europe's ongoing recession towards the US and especially Asia's growing middle classes. These are much better opportunities for growth than Europe's demographic and business decline, which is long term. There are three problems in Europe likely to lead to continued underperformance relative to the US and Asia. Firstly, there is the inability of European member states to reconcile their domestic policy agendas with the real issue of fiscal union. It's hampering effective economic recovery right across the European Union. There are serious issues in terms of delivering policy goals, including corruptions in part of East and South Europe. You need strong domestic government to solve these problems rather than centralising power in Brussels. That's fundamental. The second issue is the ECB's tinkering with monetary stimulus. They've tried everything and none of it is working, except within Germany. It's simply sustaining what is broken rather than replacing it. The normal way markets function is broken down. The current debate within the EC about ending QE early just sums up the dither and conflict within the ECB. The third issue is reality. While Europe is sinking, there are more attractive relative opportunities elsewhere. It simply makes sense to move your investments. Now, the Norwegians clearly have faith in the global economy, which is why they're investing all their money there. It's pretty clear they don't have so much faith in Europe. So, should you listen to bankers when they say that Europe is undervalued? Or should you put your money where the markets are, the rest of the global economy?